Hello, everybody. So I've been very busy this week. Lots of deals in the market. Right now, I'm looking at Tesla. I'm looking at Transmedics. I'm focusing on my higher conviction plays, but of course, you know I've been doing these videos, these subscriber stocks videos. So this is another one of these. Just know whenever you drop a stock name, I kind of look it up and I put it in this spreadsheet, and it's all random. So more stocks to come. I will try to get to as many stocks as I can. More stocks to come. In today's spreadsheet, really, I found one stock that I find more interesting than the rest, and I'll get to it here. That's stock number 5, called GRVY. But let me get started. So Coco, Coco is a Coco Life. It's coconut water stock. This was a popular stock a few years back. I remember seeing it on social media. The growth is expensive in my view at a 0.77, only predicted to grow at 9%. So if you compare this to, say, the growth of Celsius beverage, Celsius Holding, the energy drink, it's not comparable. And maybe that's understandable because one of them has 200 milligrams of caffeine, and that has you come back, and cocoa is just coconut water, and so it doesn't really have that addictive component that has you come back, and therefore it's a slow grower. So again, if you're interested in lower returns, maybe, but to me it's too slow. To me, the growth is too slow. Let me talk to another stock that is again too slow of a grower, is Corsair Gaming, another stock that was popular in 2021, 2020. I remember the internet going crazy for this one, and that was understandable. I mean, a lot of people were stuck at home streaming. Corsair does like stream decks and other form of gaming equipment, and it's expensive to me. It's an expensive stock for 7% predicted growth next 12 months. Gross margin is not that high. It's understandable because it's a lot of hardware, but it's not that high either. And the EBITDA margin is not that high either, and 11%. And so Corsair does not pass my quote-unquote test or the way I value stock, even though it's cheap, right? It's trading below its sales, but, kind of understandable given the lower gross margin and the lower growth. Now, moving on to Grab. Now, Grab is one of these stocks that I wish I had known about earlier because it's had a good run, and I would say perhaps too good of a run for me, and I think it's a little late for me to get into this one. Grab is a food delivery business in Asia, not China, but Southeast Asia. Very popular over there. Revenue growth is 31%. In Asia, actually, food delivery is extremely popular over there. Perhaps much more popular than in Europe or in the US. Growth is 31%. Gross margin is 36%. Again, that's a little low for a platform. I would like to see this higher. They are still losing some money on an EBITDA margin basis, which is what I use on this spreadsheet. And so if you use all these numbers, you get not a rule of 40, right? You get 18%, and revenue growth is is high at 31%. But again, somewhat of a more expensive company for the growth. I think this stock has already earned now. Let's talk about BFLY. BFLY is actually a stock that I used to own. It's one of my investments where I lost some money. I mean, we all have some of those, and thank goodness that was a very tiny position for me. But poor BFLY. That stock took a nose dive, and I already took my loss on it and moved on. That was a tiny position. I'm glad. I'm glad to see that they're still around. That's good, but still expensive for that growth. The problem of a lot of these companies that my subscribers, recommended, the problem is that the growth is just too low. And it really highlights how special some of the companies I cover on the channel are, because they are profitable and they have high gross margin and they have high revenue growth. When I look at BFLY, the product of BFLY is so compelling, right? it's an echo ECG, right? And an echocardio, not echocardio, but echo something. It's an ECG for doctors, and you can use it for pets. You can use it obviously for what is it, for pregnant women is what it's used for in general. But it's the problem is that you have a lot of competition. GE is very, very big in the medical space. You have a lot of competition for these systems, and even though the value proposition was great, selling this to a lot of emerging markets, emerging nations, etc. It still doesn't seem to be catching on, because revenue growth at 7% is just too low, and they're still losing money on these devices. And I used to like the idea of this stock. Moved away from it. The growth is too low now. Before I go to GRVY, let me tell you more about Pagaya. Pagaya is a stock I've been following. It's a stock that I found interesting before in the fintech space. Right now, there's too many deals, so I'm not focusing on this opportunity just yet. But this is a stock that I will focus on later on the channel. You can see it's a cheap company, it's a cheap stock. They did a capital raise recently. I listened to the full conference call of that one, and this is one that I'm potentially interested in, but not when Tesla is trading at less than 170, right? Not when we have these prices. Now, the one stock that my subscribers recommend that I find interesting is this one, GRVY. So GRVY is a maker of, and I quote their website, it's a non-violent, non-explicit video game called Ragnarok. It's an Asian video game. It seems to be manga themed, and if you hang out on Twitter a lot, you know that every other day there's something trending related to that manga culture, and so it seems like a manga game, video game, right? A video game, but very interesting stock. It's a stock that has a lot of cash on the balance sheet, so their enterprise value is actually pretty low at 181 million. The revenue growth is 549 million, 33% gross margin. Again, what are they doing here? I don't know. It's a very low gross margin for a digital business. It should be higher. But look at that valuation. The enterprise value over sales is a 0.33, and it is trading at a 0.09. Now, the reason why it's trading at this level is because I was not generous with GRVY, and I only gave it 11% revenue growth, and that's kind of my guess. That is how I guessed it. They actually had more than 50% year-over-year revenue growth, but they seem to have a pretty spotty revenue, with some quarters being very high, other quarters being very low. That's because their revenue is inextricably linked to the popularity of their video game called Ragnarok and all of the different variants of that video game in Asia. But if this is a stock that was growing at say 20% or 25%, it would be so cheap, right? It would be cheaper than HIMS, cheaper than StoneCo. It would be dirt cheap if they were growing at more than 11%. So I find that stock interesting. The problem is it's a Korean company, and it's not only is it in a space that I know nothing about, right? Video games. It's Korean, so again, I don't understand that culture nearly as well as Western culture, and I have no idea whether the video game is highly popular or not. So for me, this would be a riskier stock, right? Because I don't have that insider information. For you that might be interesting if you know that space, if you know that business. The valuation is very compelling on GRVY, and that is the most compelling here out of all of these, in my view. GRVY is the most compelling and definitely worth a look. At least I will be taking a look. Unless Tesla keeps dropping, in which case I'll be keeping buying Tesla. In which case, but I'll be taking a look at GRVY. Maybe an in-depth video is coming on this one. So. Thanks for watching. This was not investment advice, no financial advice, just entertainment. Appreciate your likes. I appreciate your subscribes. Have a wonderful day.